you choose debt or equity? How many percentage we need of debt? And how many percentage we need for equity in a firm? So, in this video, me and my partner will be explain about capital structure theory. Before we begin, let me introduce myself first. Hi, Assalamualaikum. My name is Nur Atika binti Ahmad Musyadat and I'm from BA 242-3C. And joining with me today is...
I'm Nur Asfa Kistina binti Muhammad Nazri and I'm from BA 242-3C. Have you ever heard of capital structure before? Capital structure is made up of debt and equity that are used to finance its asset. It helps a business to decide on the type of capital that are used to fund its overall operations and growth. The purpose of capital structure is to inform the investors about a company's risk profile. As a general rule, the greater the share of debt financing used by a business, the greater its risk exposure. On the other hand, the financial management will strive to maximize the shareholder wealth by lowering the weighted average cost of capital.
Now, let's discuss on the main issue of capital structure. The main issue is the relationship of capital structure and corporate performance before and during crisis. In 1997 crisis, the primary cause that accelerated economic suffering was an increase in debt finance dependence. Before the crisis, the dependence had led to excessive investment and economic instability in Malaysia. Prior to the financial crisis, banks' information gathering skills for monitoring borrowers were exaggerated. In addition, it cannot be accurately evaluated due to the government's protection of domestic banking industries. Due to their proximity to financial distress, high-leverage companies seek the growth of capital markets. This scenario resulted in a higher cost of debt for high-leverage companies in the post-crisis period compared to the cost of debt in the pre-crisis period. Aside from that, the results suggested that high-leverage companies can greatly boost their earnings by issuing equity or reducing debt. However, companies with a high debt-to-equity ratio cannot reduce their debt during the post-crisis period due to their inability to make profits through ordinary operations.
How to determine the optimal capital structure? In order for a business to have the right capital structure, the optimal debt-to-equity ratio should increase the firm's value while lowering the overall cost of capital. The value of a business cash flow goes up when the weighted average cost of capital goes down. This is because values and discount rates go up in the opposite direction. There's no perfect combination if you don't think about taxes, financial hardship expenses, and other problems. Under these conditions, it doesn't matter how business gets its money. When we look at how taxes affect businesses, we can see at how important the capital structure is. This conclusion is based on the fact that interest is tax deductible, giving a large tax benefit. Now, we're going to discuss on the elements that influence the capital structure and decision to choose a capital structure. The capital structure is influenced by a variety of factors, including economic growth, increases in the firm's value, cost containment, and investment opportunities. A country's capital structure boosts investment and growth by increasing a firm's ability to make future-creating investment. Next, we're going to discuss on the capital structure decision. Okay, generally, a business can choose any capital structure it desires. Therefore, we may evaluate the capital structure decision apart from the firm's other operations, which means that a business capital restructuring decisions can be analyzed separately from the investment decisions.
Next, I will discuss about financial distress. Financial distress is a term used before a business declares bankruptcy. Financial distress occurs when a company is unable to pay its creditors and lenders. It is like when a company has high leverage and low profit, and they are sensitive to economic recession. So how to solve this problem? Manager may force to sell their assets and lend their personal money to the company and make decisions to decrease expenses in order to get out of financial crisis. Another problem is employees that seek for work somewhere else, so there will be a rapid decline in the level of experience and knowledge employee within the company. Now, I am going to present information about integration of tax effect and distress cost. Here you may have question, what is financial distress cost, right? Basically, it is the cost of financial distress which a company finds difficult to pay back obligation and also liabilities. Indirect costs, conflict of interest, bankruptcy costs, higher cost of capital are the example costs that are involved in financial distress costs. Usually, a company will make a loan on short-term and long-term basis to support their business operation. According to the points of view and research finding, a firm value will increase when the company start moving towards debt from equity. Now, come to the impact of debt financing. In this situation, the probability of distress is low because of the present value of minimal distress cost. Thus, every little increase in debt value will increase the present value of this cost. At some level, it will come equals the increase in tax shield present value. Here, bankruptcy will increase rapidly from the tax shield that will cause to decrease the firm value. So, this graph represents the integration of tax effect and financial distress cost, where the present value of financial distress cost increase and present value of tax shields on debt will also increases. This means that they are integrated to one another. Next, I will be explain about bankruptcy costs. Bankruptcy costs can arise from the evaluation of the entire organization. A higher cost of capital and a higher level of risk can actually increase your risk of bankruptcy. As the company adds more debts to the company capital structure, company WSEC increase to the optimal level. To keep away from the financial being collapsed, company required to recover all bankruptcy costs when determining the amount of debt to be taken, or either they should increase their debt level altogether. In short, direct bankruptcy costs are when company goes economically bankrupt in the sense of the capital has no value, when the value of its asset is equal to the value of its liabilities. Next, I will discuss about pecking order theory. This theory is like following a financing hierarchy, starting with retained earnings, debt issuance, and equity issuance. For your information, internal financing is the easiest, cheapest, and the most convenient way as the sources of financing, as there is no banker involvement. Positively, investors and public will see how the strong firm performance, as it doesn't need an additional funding to finance itself, and if a firm could not finance itself, the manager will decide to use the external financing by issuing debt, either by selling bonds or pledging the assets to raise the firm's loans. But through debt issuance, the investors will see that the firm is confident enough in taking risks to meet their monthly obligation, in making more investors interested in their firm. Lastly, equity issuance. Equity issuance would be the last choice of source financing for the firm because it is the most expensive way among the three in the financing hierarchy. And issuing the equity could stipulate the firm shares is overvalued, and it will send a negative signal to the investor as the price of the firm shares will hit the higher price and their shares drop anytime. Next, I will discuss about the cost of agency equity. Agency equity costs represent the costs incurred by a company due to issues in the management and also shareholders. For example, the cost of problem caused by the differences in the overall interest of shareholders and management. Information asymmetries also include in the agency equity cost. Shareholders will incur such costs when management interests do not match what is required. For example, managers will make a decision that causes the value of firm to decrease. Then, to control this problem, shareholders will take measures that increase the cost of agency equity. For example, the cost expenditure for the monitoring process is to prevent managers from making wrong decisions is also included in the cost of agency equity.
Now, let's move on to signaling hypothesis. In general, the dividend signaling hypothesis predicts a positive correlation between the dividend changes and price reactions to dividend changes, as well as a positive correlation between dividend changes and future firm earning and analyst earning projections.
I think that's all for our presentation. Thank you for listening.